Welcome to the Finance Forum. I'm Abdu-Raof Hanslo. Today we look at a very important topic which affects both you and I when it comes to our financial planning for the future and our general savings. Today the topic is savings and exactly what's best for us all. My guest in studio is Mr. Etienne Wilsnach from Alchemy Financial Services, once again a regular now on the Finance Forum. Good day to you, Etienne.
Hi, good day, Abdu-Raof.
How are you, firstly?
I'm good. I'm celebrating the end of winter, though we didn't have enough rain, but I'm good, thank you.
You know, when I looked at the topic earlier, and I thought, we came out of a month in July, and that month was General Savings Month according to the Savings Institute of South Africa, and I thought this is just so important to highlight at the moment the pitfalls our community currently experiences, as well as the incorrect advices given and by our regular Friday financial advisors. And I think to clear the air up totally from a financial planning perspective, I think it's best that you take us through exactly, firstly, why we should be saving money.
So when you and I started this conversation and said, how do we inform and educate our community and the people that we grew up with, I think this topic is that one element that could change not just lives presently, it could change communities, it could change generations, because it's habits that the wealthy have followed from early days. The capacity, the ability to save, it's biblical, the Quran talks about it. How do we separate from our day-to-day income for latter days? And I think we've lost that culture through a lack of education, specifically in our community. So I think for you and I to be able to talk about it today, sincerely, it offers them the opportunity to see that differently and then change their lives and the quality of their lives.
Now, when looking in the South African context, South Africa's still fairly a new democracy where we saw an array of products being launched after 1994, and also what we've seen since 94 to present date is a roller coaster ride in performances, a roller coaster ride in investments, and a roller coaster ride basically when looking at our stock markets of exactly what happened. We've gone through some boom and bust phases in our economy. We've also gone through excessive growth in our economy during this period. So in your opinion, Etienne, why is this more so important for South Africans to be looking at creating a savings culture?
So there's two sets of realities. One is the post-democracy, where you had people that were accustomed to poverty. I look at the government sector 20, 30 years ago, there was not a black institution. And now you've got all these people, and I visit them, and there's roads of people that have now been afforded the opportunity to earn a livable income. The problem with that is poor behavior. The spend on motor cars and material and retail. Our biggest competitor at the moment is the retail sector, not ourselves. It's not companies competing with companies. It's us actually competing with behavior, and we're losing the fight against retailers, because they're the ones that's taking the bulk of people's income at the moment. The problem is there's no return on that. That's a spend, that's money that's going one way. And I think it's critical for us to change that. But then you look at our European culture, you look at Australia, for example, the need to save massively is not that important because their currency is strong. Their need to save is not that because they have got government support systems that's in place that will provide them with free education. In Australia, there's called superannuation, for example, that it guarantees you a quality retirement. In the United Kingdom, if you have a kid, you're on the dole system. We don't have that in this country. We are part of Africa. So I think as long as we are looking at government to help improve the quality of our lives, we're going to lose that battle. So what do? We need to teach our people that we need to take our own money and provide for our own quality of life. And the best way to do that is to separate some of it. Pay yourself first.
Since 94, let's first look at pre-94. Pre-94, we had an elitist group of people that we could clearly say that there were a small percentage of our community that owned most of the wealth of South Africa. Today, that's broadened to a vast extent, whereby we're sitting with 52 million people as our population grows. And in that 52 million people, we find a lot of professionals coming through. We find an array of wealth, not array, but a huge amount of wealth actually coming through to people who did not have facility or did not have exposure to that type of wealth prior 94. Yeah. Etienne, now, when looking at that, in today's culture, there's one major thing that always comes through from the Department of Finance, the Ministry of Finance. One thing that comes through from them, one thing that comes from the Association of Investments and Savings. And that's always the same story: we are not saving enough. Why is that? Why are we not? What is the culture behind it? What's the reasoning behind our community being in the industry and engaging with people? Why are people not saving enough money?
So it's easy to say, like in most of my other episodes, ill discipline. I think in this case it's not that simple. We have a scenario where people did not have before, and now they've got access to. So they can now go and buy homes in areas of choice. They can drive cars they want to. As I said, we are competing with the retailers.
Yeah.
What we need to do is we need to educate them to the point where they understand the value of saying, hey, if I'm earning 10,000 Rand a month, how can I separate, even if it's 200 Rand, and invest that for inevitable, for Hajj, for putting my kids in education, and why it's important. People aren't seeing the importance of it yet, and they justify it. So they'd rather have the best bouquet in Deen TV, they'd rather have the new Nike, but they will then justify why they cannot save money. And it's an education process. There's no way of getting around that.
Now, from the Finance Forum side, we've always propagated empowerment and education. And we hope that we're making a dent somehow in our communities' lives by encouraging them to look at various ways of improving their life going forward. You've been in the industry for 24 years, and in that 24 years, you must have experienced a tremendous amount of characters.
Yes.
You must have also experienced a huge amount of differences in disparity when it comes to wealth. In that 24 years, is our situation getting better, or is it getting worse?
I'm going to say this with absolute certainty: it's getting worse. And I think what's contributing to that is this whole concept of contractual employment, which is the new thing. So you have somebody that in the past was employed formally, he had a pension fund contribution, he had a pension fund deduction, and there was money being saved up on his behalf. The new buzzword now is I'm contracted. Yeah. So the problem with contracting is it leaves more cash, more disposable cash in your bank account, because there's no deductions, there's no medical aid deductions. The problem is then that the discipline for you to separate some of that into savings is left to you.
Yeah.
And that's the problem. People aren't doing that. So I'd rather buy the new car and change it every other year, and I'd rather buy the fancy clothing and the new cell phone, but I'm not saving. And if you look back at the 2015 reform by government, and sadly we don't have the trust in it, but if you look at it, you'd understand the importance of that in changing behavior. Because if we do not, 20 years from now we're going to have a big problem in this country. We need to change behavior now.
Now we're talking about time. I mean, in 20 years, to some that might seem like a lifetime, to some that might seem very short. Now, I know that in being in industry, being in finance, being in investments, we very quickly realized that a lot of our people have this idea of quick, rich schemes. I'll invest my money in a specific share, and in a week's time, if it performs well, I'm going to be rich. That's the mentality that we face. So when looking at from a financial planning perspective, obviously you would have your short-term savings and your long-term savings. I never ever look at short-term savings.
Okay.
To me, it's always long-term savings. But as far as product choice is concerned, what's on offer to the community and to our viewers as far as the two different types of saving, short-term and long-term savings?
Exceptional question. Thank you so much, because it allows me to create context. People have never been taught that your savings vehicle should be chosen alongside your goal. What is it that you want to achieve through that investment? So if I have a baby that has just been born, and I say to your trip, I would like my son or my daughter to have sufficient funding to go to UCT when she's 18, because I have hopes for her. The goal is tertiary education at the age of 18. That is the term, and term determines the choice of investment vehicle. Compounded effect, and I do not want to have access, because that's it. If you come and say, Etienne, I'd like to go on Hajj in 2020, then I know I've got 2.5 years left. The term is 2.5 years. I then select a product based on the term and what my goal, what is the desired outcome for that. And that's the part that people are missing, and often misinformed. So you'd come to me and you'd say, Etienne, I want to go on Hajj in 2 years' time, but you end up with a 10-year investment plan. And then when you do get to have to cancel it, there's penalties, you lose, you don't see return, and then you lose faith in the process. So the first term, what is the goal? What is the desired outcome? Where am I going with that? And then you choose the appropriate vehicle to solve that on behalf of the client.
Now, you know, Etienne, we live in a country that has gone through a tremendous amount of heartache, a tremendous amount of goodwill, and we've evolved into a country that's basically that promotes freedoms of choice and freedoms of living, freedoms of religion, and all sorts of freedoms.
Yeah.
Here as well, we were fortunate, very fortunate in 2008 from an economic perspective, that we were protected against a tremendous meltdown, financial meltdown across the world. And when looking at that entire perspective, from that perspective, if we weren't protected to the extent that we were by our legislation that was put in place to cover our banks and to cover the industry, the finance industry, we would have been far worse off than before. So what I ask you today is, we are we're coming out of a technical recession at the moment. Has there been legislation put in place to protect us once again against any harshness from that perspective? Number one. And number two, what should our viewers be looking at in the current market conditions when looking at investing?
Okay, so that is one thing I love about South Africa. So one thing we do get right is that we've been able to put legislation in place that often creates discomfort. So you look back at the NCA, people didn't like it at the time, but futuristically, when the proverbial fufi hit the fan, we were sheltered, and it's only in that moment that you appreciate the decision that was made earlier. And I think as long as we keep focus on that, we will understand that some of the decisions made presently will once again in the future protect us. So I think as a South African economy, in terms of legislation and how we're writing the laws, we're doing very well. What is also favorable is that we're often lagging 2 or 3 years behind either the UK or Australia. So we often learn from the mistakes they've made. So when we rewrite that, we're not doing that badly, and the damage occurred then even by poor choices is not that bad. I think we're on the right track as a country, and as a financial services lawmaking economy, we're very sheltered. And I'm going to urge the consumers that often if you see legislation that is not favorable in terms of instant gratification, understand why those decisions are being made, because it will have a positive long-term impact on us, and that's what we need to focus on. Your second question is, what do you look out for? And this intrigues me, because we see that all these schemes that's happened, the Ponzi's, the Kings, for years, and still today, I meet people that wants to invest in unregistered schemes, and the first thing I look at is they say, yeah, but I can get a return of 30%, and I say, but hang on, present market conditions are highlighting single-figure returns of 8 and 9%. Why is PIT getting you 30%? Aren't you concerned? And then if that investment does go wrong, who's going to protect you? There's no ombud, there's no financial services industry or regulation that's managing that process. Why would you even consider that? So the whole adage, if it sounds too good to be true, it is. Okay, so if you're going to look at returns and if it's not aligned with present market conditions, don't go there.
Now, early on, coming back to savings. Early on, you mentioned that when basically divorcing the two, long-term savings, short-term savings, there's obviously this other umbrella that follows us, and that umbrella being that empty nesting retirement age.
Yes.
So to me, that's probably the most important savings in my life, is to look at retirement. But in your opinion, Etienne, do you look at general savings and retirement savings as two separate modules in life? And how do you advise and balance those two out when sitting in front of a client and working out a financial plan?
Okay. So, me personally, for the last 24 years, I do look at them distinctly differently, under completely different headers, for two simple reasons. They are both regulated differently. So the Pensions Fund Act is very specific in how it's constructed, and then you look at products like unit trust and endowment and recently our tax-free savings plans. The laws that regulate those products are distinctly different. But more so, again, my advice to the client, to the consumer, your product must be aligned with your goal. What is it that I want to achieve? So if I come to my advisor and I say to him that my conversation tonight is specifically around retirement, and when I get to 55, 60, 65, I'd like to retain my quality of life and I'd like to earn the same income I did then. Let us have a conversation. Then my product offering is going to be very distinct. I'm not going to use unit trust. I'm not going to necessarily use, because there are products that's available to us in our basket that is designed specifically for retirement. There are tax breaks. There are methods how it's paid out. It's preferentially taxed at receipt at retirement as well. So why would I deviate from that offers? South Africa's got a very unique offering in how it sees retirement planning, both in the pension fund arena and retirement annuities. I personally think it would be a sin if I'm looking at retirement planning and I'm using short-term vehicles as a conversation. So short-term vehicles talks to my kids' education, going on Hajj, going on my overseas holiday. I'd like to purchase a new car. I'd like to accumulate deposit for my next property. That is short-term need. And that product range is completely different. The laws that regulate them are completely different. And it's for that specific reason that you should not be mixing the two. The offering is different.
You know, Etienne, speaking about product range, I remember the 80s, and I was a schoolboy in the 80s. And in the 80s, I remember the gentleman in the cheap suit and the tattered suitcase coming to knock on the door, and he was the insurance salesman.
Yes.
And products at that time that was sold was basically life-linked products, or that was my understanding at the time. So we called them life insurance brokers, because everything they sold was everything to do with life insurance. And the one product that stands out specifically, that many of our community and many of our viewers probably invested in, was the endowment policy. Now, I'm one of those that looks at all different products in the finance industry, and I say there's a need for each and every one of them, and there's a circumstance for each and every one of them. When looking at those policies today, now I'm talking about the old age policies, endowments, and I'm looking at the new age endowment policy. When looking at those policies compared to unit trust today, I'm not going to ask you the question of which is better, but I am going to say to you, I am going to ask you, where do they fit in, and how best do you advise clients when looking at investing in either one of these products?
Okay. This is that one question every week where you, well done.
It looks like, unfortunately.
So the reality is that if you purchased any of these products pre-99 2000, they were then called universal products, and often your risk element and your investment, your endowment portion was linked in the same product. at the time, and I need to defend both the industry and the people that sold them to you. At the time, that was the best product available in the market. So don't hate your broker. It's all he had in his basket at the time. Okay. Post 2000, however, the structure of this product had changed. The industry had separated them. They had divorced them. They've taken risk and they've taken endowment and they've separated them. If you're still stuck in one of those old products, my advice to you is get hold of your broker immediately and assess it, because they are dated and they are not good value for money. Okay, so endowment, there's an absolute place for it in the market, specifically for the longer term investment stuff. Okay, and there's tax benefits to that, but separate them from your risk. Don't confuse the two. They are priced differently. Life insurance is no longer linked to investments. They should not be. It's a cardinal sin.
Etienne, now you briefly spoke about the tax breaks and things that you can basically, endowment policies are structured differently as far as tax, because I think it's taxed within the four fund approach. There we go, the four fund approach. So in today's day and age, there's obviously more products that's come to the market that can give you various different tax advantages and tax breaks at the same time.
Yes.
And the hot topic over the last 5 years has been the tax-free savings products.
Yes.
So these are obviously certain, they fall within a certain sector of investing. What are these products all about? And are they really saving people tax? That's the main question I think that our viewers would want to hear.
Okay, it's an exceptional product. Second to, I think, retirement annuities, statistically, it's been proven probably to be the best investment vehicle available to society at the moment. So a bit of the history on that. So both government and the sector had realized that there's a culture of non-saving in this country. So how do we incentivize people to save? How do we get them to save extra money? What we've done is we've looked at all the pitfalls of a standard investment. So you looked at high cost, commissions payable, non-accessibility of the funds, and then of course the taxation of the proceeds of those funds. So they've designed this new product called TIS, or the tax-free investment vehicle, which no commissions are paid, very low administrative cost, there's no term link, so in other words your money is accessible at any time, and your proceeds to a maximum of 33,000 per annum, presently to an amount of, I think it's $500,000 in your lifetime, can be invested without any tax being attracted to it. So what we've done is we've taken all the weaknesses of the traditional market and we've cured them in one product. If you're not using that as your primary vehicle, then you're throwing away money. Yeah.
Now Etienne, as we reach the end of this segment, your advice to in 2 minutes, your advice to our viewers concerning when approaching any type of investment. What's the best thing they can do when trying to invest money?
Okay, so be clear on your goal. Know what it is, what you want to achieve through that investment. That's the first. If you don't have that, don't make the move. Secondly, apply the discipline. We call it the Pareto rule, 80-20. Take the first 20% of your income and try and invest that. Pay yourself first. Okay, it's really about discipline. It's about getting into good habits. If you look at the principle of what makes the great great, all great people, all people with wealth, people that have achieved, have the capacity to save, to separate off their monthly income and invest it, even if it's only 50 Rand. If you want to change your life, be clear on what it is that you want to achieve, select an amount that you can afford, and find a vehicle that will solve that problem for you. But you're not going to do that if you don't have discipline.
Etienne, it's always a pleasure having you in studio. It's always a pleasure listening to you, and always a pleasure to have you impart your knowledge to our viewers on the Finance Forum. The one part I want to add to what you've just said is, I think from our side is, we always propagate fit and proper advice, and in saying that, we would like to encourage our viewers to seek professional financial advice from a registered and accredited financial planner or financial advisor. You've been watching the Finance Forum with myself, Abdu-Raof Hanslo, and my special guest in studio, Mr. Etienne Wilsnach from Alchemy Financial Services. We've been speaking savings, and I hope that you've benefited from from the knowledge of my learned guest in studio today. Until next time, stay focused to your finances.